Howdy hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. It's Wednesday, February 10th. What do we got going on today? We got the stock market hitting new record highs. Nothing new there. Doesn't surprise anybody. Record high after record high after record high. Economy record low after record low after record low. They print the money, the stock market goes up. But hey, we got to talk. You want to use extreme caution here, and I'm going to go over a couple of my trading secrets. You're going to like this stuff. This is why you subscribe to the channel, to learn. Here's some secrets. Okay, let's look at this chart of the S&P 500. All right, so what have we got? Okay, so we've been going up, consistently up, record high, record high, record high. Okay, now why are we at record highs? Well, we all know market is not real. Market is fake. It's propped up with the printing of money. Now, what I want to talk about today is the bear market. Now, we haven't had a bear market in the last 12 years. The last bear market was back in 2007, 2008 during the great financial crisis, right? Okay, so we've gone straight up. Now, why have we done that? Well, we've done that with, the QE, the printing of money, quantitative easing. They call it stimulus packages. Now it's no longer QE. I don't really know why it's not QE anymore. You can't say QE because that would mean QE didn't work. It doesn't work. You can't print your way to prosperity. You cannot do it. Now, yes, we've had corrections. We've had these corrections, the drop downs, the little pullbacks here and there. This last one, only about a 5% correction, right? Now, a bear market happens every 4 to 5 years. You're going to get a bear market. Now, we haven't had a bear market in 12 years. Why? Because no one wants to feel the pain of a bear market. They think we can keep printing our way to prosperity. Because you know what happens during a bear market? Well, somebody's got to get the blame. It's usually in politics. It's usually the president gets the blame. Hey, it happened under your watch. Why do we have a bear market? Well, because the Fed stopped printing money. Well, don't stop printing money and we won't have a bear market. Now, maybe that's true. Maybe that's not true. But we're going to eventually get a bear market. And when we do, it's going to be bigger than normal. A normal bear market drops 35 to 40%. But when we actually get a bear market, it's going to be bigger this time because we've held off for 12 years. It's probably going to be double that, which would put it in, the 70 to 80% range, maybe even 90%. That would just be horrendously painful. And people don't want that pain, so we're trying to kick the can down the road. And that's all good and dandy. Now we've got new highs, but at some point, it's going to stop. Now, what I want to talk today about is when it's going to stop. Now, I don't think it's ready to stop yet. Why? Because it's tough to go into a bear market when you're going to put another $7 to $10 trillion and pump it into the market. Now, the market will be going up, but your dollar is going to be collapsing. Okay, where dollar is going to be collapsing. Now, we may just get a financial crisis of the dollar and while the market continues to head higher. But we're in for a change right here. Use extreme caution. I'm going to give you a couple of my trading secrets right now. How do I know to use caution right now? How do I know to pull my positions off the market? Now, I'm not saying to go ahead and short this market. They can keep printing money and come out with new stimulus packages, and maybe we head higher. But this is why I want you to use extreme caution. All right, we got a chart here of the VIX, which is the Volatility Index. Now, the Volatility Index spikes up when the market goes down. It spikes up. It's a fear index. How much fear is in the marketplace? Now, down here at 20, there's no fear in the marketplace. We hit down here at 20 just earlier today. We're back to 21 now, 21.55. But this secret that I'm about to give you is you can use this. Okay. The volatility index is used by professional traders. Most retail traders, the people trading on Robinhood, don't even know there's a volatility index. Now, if you look at the options of the volatility index, you will pull up the call options. Do this yourself. Go out till March expirations for a 21, which is where we're at right now. We're at 21. And pull up a call option versus the put option for 21 for next month's strike price out in March. Okay, what you will find is the call is selling for about $6 while the put is selling for about 30 cents. In other words, there's no more downside, and everybody expects this to spike up again past $26, past $27, because they're paying $6 for a call option just for March. So that means somewhere between now, mid-February, and mid-March, we're going to have a pullback in the stock market. And the pullback could be a little bit more severe than just 5%. It could be 10, it could be 20%. But these would still be within the range of normal corrections. And you'll probably want to buy them. Now, when's the bear market coming? The bear market is coming later this year. Later this year, probably summertime. Summertime, let's call it July and August would be my best guess for the bear market to start. Now, a correction lasts only maybe 1 or 2 months, a couple months, but a bear market lasts about 12 to 15 months. And we're going to get one, and it's going to be painful, and it's going to be extreme painful this time because we haven't had a bear market for the last 12 years. Take my word for it. Now, we want to buy the dip on this next correction. I think the next one's just going to be a correction, and that's going to be within the next month. That could start later this week. Into next week, we're going to see the market come back in. Now, you won't hear this from other people. Watch CNBC. Everybody says, well, the correction already happened. It's over. We're just going to go straight up from here. No. Mark my words. We're going to get this correction, and it's going to happen. It's going to start maybe later this week, but probably next week, and definitely within a 2-week time frame. So just be careful here. If you got a lot of positions on there, you might want to lighten up. Now, this is not financial advice. This is not, I'm a gambler. I'm a stock market gambler. You do your own trading, but check for yourself. Check the VIX. Check the options on it. The call versus the put. $6 versus 30 cents. Professionals know that a correction's coming. All right, what else we got? This one, nobody even knows what this is. Okay, this is a call, the put-call ratio. Go to stockcharts.com, type in the $, followed by CPC, and you'll pull up this chart. $, followed by CPC. It's the put-call ratio. Now, you'll notice the put-call ratio, when it's below 80, we're down here at 67. Here's the 80 is the 200-day moving average is 80, but we're down here at 67. This means the put-call ratio, okay, they're buying a lot more calls than they are puts right now. Okay, the put-call ratio, when it's down here below 80, that means that the stock market is getting ready to change directions, and it's going to start to come in, and this will start to go higher. Now, when this gets up to past $1, up to $1.10, let's say, that means it's expensive, and that means that it's time to buy the market. When it's down here, it's time to take some of your profits off in the market. It means that the market is expensive. And what this really is you got people out there gambling on margins. We're at a record high in the stock market, but we're also at a record high in margins. Okay, people are out there buying the top of the market on margin. Margin means loans. They borrow money to play the stock market. Now, margin debt is at a record high. It's about $800 billion and headed right to $1 trillion. This is the most margin debt that's ever been in the market. The market is levered out at an all-time high. I'm telling you, a bear market's coming eventually, but a correction's coming. Get ready for the correction. But take a look at the put-call ratio. Put-call ratio down here at 67. Anyways, it's just getting too many people gambling on the market. The VIX volatility, too many people the fear is out of the market. No one's worried. Everyone thinks it's going higher. That's when you have to be cautious. Look at this. Look at the S&P. Yes, we're in that uptrend. You don't want to bet against the trend. I'm not saying to short this market. Wait for the pullback. We're at 391. A month from now, we'll probably get another pullback down to 370, maybe even a little lower. That's where you want to buy it. Look, we're up here at 391. The 200 days down here at 335. This is a room for a lot of pullback. Yes, you don't want to bet against the trend. You just want to use extreme caution here. That's all I want to say. Extreme caution, and you'll be fine. And when we get another correction, yes, buy the dips, because we're still in that uptrend. Buy the dips. The bear market's not here yet. This summer, I'm going to be, very careful, because I do believe this year we will enter a bear market. But today, all the skies are blue. We're up 100 points on the Dow. Get out there, do some trading. Just be very careful. Use the caution, extreme caution. I'm Tall Mike. If you like this, give me a thumbs up. All right. Helps me out. Thank you, guys. Bye-bye now.